Hey guys, my name is Ryan. I'm a tutor in the Econ Tutoring Center. Today I'm going to go over some macro review problems for using a review exam, talking about some questions of aggregate supply, aggregate demand, monetary policy, and other things like that. Remember that language and notation might vary by professor, so always check to be sure that the language that we're using is the same as your professor's. Okay, so this first question says that GDP is defined as, so that's just the definition of GDP, and that is the value of all goods and services produced within a country. D stands for domestic in GDP, so that means goods produced within the country in a given period of time, usually a year or a quarter. So that's C, right? Just the value of all final goods and services produced within a country. You don't count intermediate goods that go into producing other goods, so that's what they mean by final goods. And then services are just any services provided and the value of those. Okay, the second question says that changes in nominal GDP, so the difference between nominal GDP and real GDP is the effective price level. So obviously GDP, like we said in the last question, reflects changes in the amount of goods produced, but because it's nominal, if price levels change, that might also be reflected in nominal GDP. So that's both changes in prices and change in the amounts of goods being produced. Right, so that's just like saying that if all the prices doubled, the nominal GDP would also double, and that wouldn't necessarily reflect that that the amount of goods changed at all. That just reflected that the prices changed. Okay, unemployment rate is computed as the number of unemployed, and by definition, again, that's just the number of unemployed divided by the labor force, and then you multiply it by 100 so that you can get a percentage, which is A. Right. You can also look at the employment to population ratio, but those are different things. Unemployment is always unemployed over labor force. Okay. So some person are counted out of the labor force because they have made no serious or recent effort for work. However, some of these individuals may want to work even though they are too discouraged to make a serious effort to work, to look for work. If these individuals were counted as unemployed instead of out of the labor force, then we should have that one, that unemployment rate would increase, but we'd also have the labor force participation would go up, which would be A in this case. Right, so the reasoning for that being, because remember, unemployment rate is equal to unemployed over labor force. Obviously, labor force is defined to be all the people who have looked for a job within a recent amount of time. And unemployed are people in the labor force who don't have a job. So, for example, say like the labor force, say initially before this person were looking for work, you had 1 people unemployed and a population of 3 people, or a total labor force of 3 people, right? Which is 1/3, so 0.33 would be our unemployment rate. But then let's say if we add that unemployed person back in, we would increase to 2/4, right? Because you would add a person to the labor force in the denominator and add a person who's unemployed in the numerator, which is going to get you 1/2, which is bigger than 1/3. So consumer price index is used to, so consumer price index, what it is, it's a bundle. They take a bundle of consumer goods and measure how that same bundle changes over time, which can be used to gauge how cost and living has changed over time. Right, so they'll get a typical bundle of goods for a consumer, including goods and services that that a typical household or a typical group of people might consume, and then they measure how the prices of those goods change over time, and it's one way of measuring inflation. Okay, so which of the following statements about real and nominal interest rates is correct? Okay, so let's look at the first one. When nominal interest rate is rising, the real interest rate is necessarily rising. When the nominal interest rate is falling, the real interest rate is necessarily falling. That's not true because remember, I nominal is equal to I real plus inflation. Just because this is increasing doesn't mean that this is increasing. It could just be from inflation. And same goes for when it's decreasing. Okay, so if the nominal interest rate is 4% and the inflation is 3%, then the real interest rate is 7%. That's not true, right? Because if this is 4 and this is 3, then this would have to be 1, not 7. Okay, an increase in the interest rate, an increase in the real interest rate is necessarily accompanied by either an increase in the nominal interest rate, an increase in the inflation rate, or both. So that's not true because real interest rates, say rose from 3% to 4%. We could have anything happen to inflation, and that would change what happens to nominal. So, right, like I said, if it rose from 3 to 4%, let's say that inflation decreased, or that we had negative inflation, deflation, so let's say like negative 2%, right? Then our nominal interest rate would decrease even though that our real interest rate increased, right? Because even though we went from 3 to 4%, because we lost 2% on this, we're going to lose 1% on our nominal interest rate. So just because real goes up doesn't mean that inflation necessarily goes up or nominal necessarily goes up, which means that the correct answer is our last answer here, which says that when the inflation rate is positive, the nominal interest rate is necessarily greater than the real interest rate. And that's true, right? Because if this is a positive number, right, then you're adding something to the real interest rate, which means that nominal will be greater than real. Right, another way of looking at it is that inflation is exactly equal to I nominal minus I real, right? And if this is positive, if this number here is positive, then obviously nominal is greater than real. Okay, right, so obviously the answer is D. Okay, so Sue Holloway was an accountant in 1944 and earned $12,000 that year. Her son Josh Holloway is an accountant today and earned $210,000 in 2013. The price index was 17.6 in 1944 and 218.4 in 2013. In real terms, Sue Holloway's income amounts to what percentage of Josh Holloway's income? Okay, so what we're going to do here is we're going to try and get these incomes into a single denomination, into a single year's value of currency, right? So that's what this price index can be used for, right? So then we know that prices in 1944 were at 17.6, and in 2013 they were 218.4. Right. So what we can do here is if we divide both of these by 100, what we'll end up with is the amount that prices changed between this year and the base year, whatever the year was defined to be. It was obviously sometime between 1944 and 2013 when prices were at a price level of 100, which was just kind of set arbitrarily as the base year. Okay, so these were the price levels in 1944 and 2013, and we're trying to convert these incomes, 12,000 and 210,000, into a single price, into a single year's value of currency, right? So I'm going to call this real income, right? And what I'm going to do is I'm going to take their nominal income, which is 12,000 in this case, and in this case it's 210,000. And in both cases I'm going to divide it by the rate that prices change from the base here, in which case the price level is always 100, just by default. That's how it's defined to be, right? So in that case you're going to be dividing 17.6 divided by the base year's price level of 100, and here you're dividing 218.4 divided by 100. So the income in 1944 is just, if you calculate this whole thing up here, and that's going to be equal to 68,181. And if you did the same thing for 2013, you just calculate this guy over here, you would get 96,153. And now all I want to do is find what percentage this is of, I guess in this case, Sue's income is of Josh's in 2013, which is just 68,000 divided by 96,153. So 68,181 divided by 96,153. That will tell you what percent her income was in real terms of Josh's income, and that's going to get you approximately 70.9%. So the answer is C. Right, so all we did was we converted there, we knew what the price levels were, we converted them so that they were all in the prices of the base year by dividing this by the change in prices, or the percentage change in price from the base year. So that'd be 17.6 divided by 100 and 218.4 divided by 100. And then we divided those, put all those under what their nominal incomes were. That gives us our real incomes, these two guys, in the base year. And then we just divided Sue's by her son Josh's to find what percent her income was of his in real terms. Okay. So now this next question says, during a certain year, the consumer price index increased from 120 to 132, and the purchasing power of a person's bank account increased by 4%. So first of all, I'm going to write this familiar equation down, which is I nominal is equal to I real plus inflation, right? And we're trying to find out what we can tell from this, right? So we get inflation from the consumer price index, right? Because we can see how much that's changed. And that is changed by 132 minus 120, it's just the percentage change formula, over 120, right? And that gets us that inflation that's really just 12 over 120. So that gets us that inflation was 10%. It would be 10% if I multiplied this by 100, right? So inflation is 10%, right? And when it says that the purchasing power of person's bank account increased by 4%, that's telling us something about the real interest rate, right? Because if a person puts a certain amount of money in a bank, and then the next year they can buy 4% more with that amount of money than they could before, that tells us that the real interest rate has gone up by 4%. So the real interest rate rather is 4%, because the value of what they have has gone up by 4%, which tells us that the nominal interest rate must be 14%, which is B. Okay, so the next question says productivity is defined as, again, this is just a definition, and that's just the amount of output produced by a given unit of labor input, which is C here. So it's just saying that how productive a labor unit is how much output, goods and services it produces. Okay. This next question says, all else equal, if there are diminishing returns, which of the following is true if a country increases its capital by 1 unit? So the first one says, output will rise by more than it did when the previous unit was added. That's not true. So here's what diminishing return says. So if this is, I'm going to call this input. So it could be anything, and then this is output. The relationship between this should be something like this, right? So if I increase at the beginning by a certain amount, I'm going to get a lot more from this change in input than when I do it, say, up here, the same change in input. This is all, right, so this change in output at higher levels of inputs is smaller for a given change than it is at lower levels of inputs. So output will rise by more than it did when the previous unit was added. That's not true, right, because that contradicts the whole diminishing returns idea. The second answer says output will rise by less than it did when the previous unit was added. And that's exactly what we said down here, right? That's exactly the definition of diminishing returns, is that when I add the next unit, I'm going to get less from that than the previous unit of input got me. So hopefully some of those problems helped you out. If you have any more questions, come see us in the Econ Tutoring Center.